Welcome to the STR Datalab.
Hello, and welcome to the latest edition of the STR Datalab. I'm Jamie Lane, Chief Economist at AirDNA, and I'm joined again today with my co-host, Scott Sage. Scott, welcome back from Italy.
Ciao. Hey, Jamie. That's all I got, by the way. Grazie mille and ciao, buongiorno. But great to be back and lots going on. And it looks like you're in a different location too.
Yeah, I'm sitting in my parents' house up in Maine, vacation rental central here near Acadia National Park. It is busy. We got up here on the 4th, and I can tell you that, at least it seems, demand is strong.
We'll see what the data says. And that's a preview for our next episode where we recap July. But today we have some exciting information to cover as we take a look into the future. So we know AirDNA has been famous for showcasing the best vacation rental markets kind of in a backwards looking manner. And we mixed it up and we're looking into the future now. We're being clairvoyant. And Jamie, you're active on Twitter. You're at a lot of events. Perhaps the number one question we get is, okay, well, what are the best markets going forward for investment?
Yeah, and it's by far the question I get asked the most. And where are you investing? It's a question that I feel like a lot of people like to answer in different ways. And with this report, we wanted to take maybe a new approach. And it sort of comes from my hotel investing days of helping sort of developers take a longer term view on where they were going to build hotel properties to capture not demand and sort of that's there today, but where's there going to be the best demand? Where are there sort of the strong tailwinds for growth in the future? And you could look at market performance today and say, all right, I want to go build in the Northeast. And then you look at how many of these markets have sort of trended over the past 10, 15, 20, 30 years. It's like, well, populations are declining, overall employment is decreasing. Yeah, it looks like it makes sense today given home values and occupancy ADRs, but is that actually the best place to go to given sort of long-term trends on demographics and what markets seem to have the best outlook going forward? So essentially, we want to take a forward view on what markets do we think are going to have the most tailwinds going forward that you could maybe invest in today and capture that in the future.
All right. That all sounds great, Jamie. Now let's actually talk about how we did it. And so we know a key factor for short-term rental success is demand. And so effectively, we're trying to look for leading indicators in markets that would suggest there's going to be a growth in demand. So help us understand the methodology and how we got to this data and this answer.
Yeah. So and sort of stepping back, and what we've seen as the biggest predictor of demand of growth over time, and is population, is employment, and is how many people are out there traveling. But for vacation rentals, for our type markets, it's a little bit different than when you think about what drives demand for hotels. A lot of that sort of local economic drivers like business growth, employment growth in that own market that is going to drive people coming in. But with vacation rentals, it's really what's happening in the feeder markets.
Can you describe a feeder market?
Yeah. So to me, a feeder, let's talk about a feeder city. So a feeder city like Houston is all this destinations that people that live in Houston travel to. So when we look at a market, let's say Houston, the top areas that they travel to are Galveston, Corpus Christi, Fredericksburg, Broken Bow, Hot Springs, Arkansas. So when we talk about outsized growth in population of incomes and employment within Houston, the markets that are going to see the downstream benefits of Houston's growth are those markets like Fredericksburg, Broken Bow, Hot Springs, et cetera. So what we maybe started with is we've seen massive migration movements over the past 4 years. So we all heard about it, the Great Migration. that happened in 2021 and 2022, and it was real. So you had markets like Houston, Dallas, Phoenix, Tampa, Austin, Atlanta saw really strong in migration. So Houston saw 270,000 people sort of move in. And that's huge. And typically we don't see these big migration movements. And then other areas like New York, Los Angeles, Chicago, San Francisco, Oakland, San Jose, Anaheim, San Diego all saw net out migration, i.e., more people leaving those cities than coming in, causing overall population declines. So, given that the destination or the place where you live has really high predictive power of where you vacation, you would think that with some cities gaining population, other cities sort of declining in population, that that was going to have a big impact on how much future demand for these vacation rental markets might have.
And so, for example, in the Corpus Christi, Texas example, Houston is the feeder city there. And so, what we're looking at is saying, okay, we know these feeder cities are contributing to demand in Corpus Christi. So, if we expect there to be population growth, income growth, job growth in Houston, those factors should contribute to a growth in short term rental demand in Corpus Christi, Texas, for example. I use the example growing up, I used to always go to Hilton Head, South Carolina, and I grew up in Cincinnati, Ohio. Those two cities don't likely sound connected at face value, but there's like Cincinnati bars in Hilton Head, and there's a bunch of like Bengals flags, and a lot of Cincinnati people go to Hilton Head. So Cincinnati is a feeder city for Hilton Head's short-term rental market.
Yep.
Summarize what we did here was we said we looked at markets and we looked at their top feeder cities and tried to make assumptions and predict which feeder cities are going to grow and the impact that has on those other markets. And so, Jamie, like for example, what does the data say about growth in feeder city population and its impact to rental demand in a particular market?
Yeah. So overall, we did sort of come up with a heuristic. It was like for every 1% in population growth in a feeder city, we see a subsequent 2.5 to 3% increase in short-term rental demand in that destination market. So real impact, positively and negatively, in terms of changes in overall population and what that means for overall demand in those vacation rental markets.
Yep. And then quickly, Jamie, that's like in principle what we sought to do. How did we execute this? So, what is the data we extracted to make these calculations?
Yeah. So one of the data points that we collect is every review that happens on Airbnb. And within those reviews, we see not only the properties that people are staying in, but the guests where they tell us they're from. So we're able to essentially do those sort of match pairs of like, all right, everyone staying in Hilton Head, in properties on Hilton Head, where are they from? Where do they live full time? And then to control for some of the sort of changes that we saw during COVID, and it very much became like different trends in 2020, 2021, we limited the data to the past year. And we actually went back and compared that to 2019, and they're roughly equal. So we felt pretty good that the past year was going to be more representative of sort of long-term demand in these markets to essentially inform what are the feeder cities and for each major vacation rental market around the country.
Perfect. And then how did we find the information for growth in that population, income, et cetera, for the feeders?
Yeah, so historical data comes from the census. So U.S. Census tracks population movements. They do surveys every year. They inform that with data collected from the BLS, from other departments. And then for our forward projections of population gains and losses, we use estimates from Oxford Economics. And they are our partner for economic forecast data that feeds throughout their DNA products on our standard forecasts and other things that we produce.
Awesome. Well, why don't we jump in? And do you want to do the big reveal of our maybe call it top 5 best STR markets for the next 5 years?
I want to start with the last 5 years because And I talked about the historical changes that we've seen in population, because in reality, like those have already happened. So there's no question that those population movements during COVID are going to be impactful. So when we look at those markets, one, the top five, it's Corpus Christi, it's Fredericksburg, it's South Padre Island, Galveston, all in Texas. Fifth is Broken Bow Lake, Oklahoma. And then the next five, and I'm going to mention those because those are all outside of Texas and Oklahoma. We get into Pine Top, Lakeside, Arizona. We get into Boone, North Carolina, the broader Carolina Mountain region, Lake Hartwell, South Carolina, Hot Springs, Arkansas. And number 11, I'm going to mention the North Georgia mountains because that's where I just most recently made my investment.
You were working hard to get that in the top 10.
Not that I was working hard to make it in the top 10, but looking to somewhat justify my decision after the fact that it's going to be see some tailwinds in the future.
This is quite definitionally putting your money where your mouth is.
Oh, yeah. So then, and as you said, we then took the forecasts of Oxford over the next 5 years, and we came up with some markets that were the same. So actually the top 5 and slightly different order, but all Texas, Oklahoma, Fredericksburg, Corpus Christi, Galveston, South Padre Island, and Broken Bow. So we can't get around the fact that the major metro areas in Texas, so think Houston, Dallas, Fort Worth, San Antonio, Austin, seeing major gains in population. That is all the sort of vacation rental markets that sort of rely on the economic growth of those markets are going to see some major tailwinds in the future. Not to say that they're the best markets to invest in over the next 5 years, because we'll talk about some other factors that should be taken into account when making an investment decision. But I do think they're going to have some strong tailwinds for future demand growth in the future, and that's hard to deny.
And this makes sense given what you said at the onset of our conversation around feeder cities, the growth, the great migration we've seen. So it makes sense that these surrounding markets should expect to see a boon in demand. Why don't we take a look at also, oftentimes even more exciting, the worst STR markets. So a lot of this game, Jamie, right, is risk management. And so making sure you're avoiding maybe markets that may be on the decline or may not be seeing the growth like some others. So why don't we go through the top 5 of worst? And again, this is just based on feeder city growth. And we're going to talk about why this isn't the full picture here in just a moment.
Yeah. And so the worst, it is going to get into and feeder city growth. So major metros that are expected to see either declines in population or at least pretty weak growth in their population in the next few years. So we get into quite a few markets in Wisconsin, sort of feeder cities with Chicago, some of the other major Midwest cities being feeder cities. So Lake Geneva, Alpine Valley, Wisconsin, Wisconsin Dells, Door County. Similarly, the Michigan West Coast and North Michigan Coastal, both in the top 10. And then we've got quite a few California markets. So when we're running through many of the markets with big population declines over the past 5 years, you're going to see weak growth over the next 5 years, were some of the major California metros. So you've got Mammoth Lakes, Big Bear, both in the top 5 for worst STR markets over the next 5 years. And then sort of rounding out the other 3 in the top 10, you've got Adirondacks and the Finger Lakes in New York, and then Bloomington, Indiana, rounding out the top 10.
Now, there is an important variable here we haven't talked about yet, Jamie, one of your favorites, which is yield.
Yep.
And so even if there's low future demand growth, that doesn't necessarily mean it's a bad market for STR investment. So help explain how we should be thinking through yield as an overall metric here and just with demand being a part of it.
Yeah. And that's where it is any investment, and you need to take into account current yield. So what is the cost of the home that you're going to be buying and what can it earn today? And that's going to give us our yield that we're using. And what I would suggest and how I'm sort of thinking about this is, and we've got this sort of scatter plot. So on the vertical axis, you've got yield. So markets with the highest yield. And essentially, these are going to be a lot of the markets in our best places to invest. And across a lot of the best places to invest type reports, they're really looking at yield. And then on the horizontal axis, for those of you on video, you're going to see my my axes. You're going to see sort of the projected population growth based on the origin markets. And where I'd want to focus in on, and in that you're going to get the top 10 that we sort of talked about. So what we want is that good mix of current yield combined with sort of strong tailwinds based on population growth in the feeder cities. And there we get a really interesting sort of mix of markets. Like, yes, we still have like San Pedro Island, Fredericksburg, Galveston. We get quite a few Washington markets. So Northern Cascades, Great Harbor, you get Boone, North Carolina. And then my favorite market right now, North Georgia Mountains. Sort of that good mix of both current yield and future demand, projected demand growth.
And just to reiterate, again, yield here is when we say yield, that is revenue. So STR revenue, bookings revenue over, so divided by purchase price.
Correct.
And, or, your home value, which often if you're making an investment is your purchase price. And so the reason that's important is like, for example, I'll use it, Red River Gorge, Kentucky as an example. Low projected population growth and income trajectory from its feeder cities, about 11% compared to 16%. So at face value, you may say, hey, maybe not the best to put dollars into or put capital into. However, with an average home price of about $137,000, that brings its current yield to about 28%, which is in the top when you look across other markets in the country. And so that's why I think it's important that we're giving a snapshot of the picture, but when making investment decisions, there are many variables to consider and different strategies to consider as well.
Yeah. Was the Red River Gorge a market you went to a lot? Because I was just looking at it, and its top feeder city was Cincinnati.
Clearly, our biases are coming through here. You keep talking about North Georgia mountains, and I'm talking about places I've been. But I think they're important examples to call out that these recommendations and these lists are important, and that's why we spent time up front on the methodology, because it is one mechanism and one way of getting to to this information. We could have cut the data a much different way and had a different result, but don't want somebody investing in Lake Geneva and seeing them at number one on the worst STR markets in the next 5 years to feel concerned or feel discouraged.
Yeah, and that's a lot of ways, and we talk about it a lot on this podcast, is there's great deals to be had in most markets around the country. And that's where, and it may take more work today to find properties that are going to have good yield. And not every property out there in North Georgia Mountains or in Fredericksburg is going to be a great deal. A lot of these markets do have pretty high home values, and they are in some ways dealing with the high population growth in that they've seen a significantly higher run up in home values because so many people are moving into the Texas markets. So that's where, in some ways, you just like with our best places to invest report, you got to take some of this with a grain of salt of like, just because it's the best place to invest now, or that it looks like it could have some tailwinds in the future, doesn't mean it's automatically going to be a great spot to invest or a good thing long term. But just through the thought exercise of thinking through these are areas that I'd feel comfortable that are going to have some great tailwinds in the future, and that you're not going to be sort of going against the grain of like, yeah, we just have fewer and fewer people coming to vacation in these markets. Like, the economy in Chicago or New York just isn't great right now. Like, and there's all these things that can work against you. So if you want to find markets that are more than likely going to have some strong positives in the future, these are the type of areas that I'd be looking at.
It's a great application. I think there's some strategies that can be applied here as well if you're an existing host too. And so like targeted marketing, seasonal planning, or local partnerships, for example. I mean, if you know your feeder cities and where your guests are coming from, you can focus marketing efforts into those cities. you could plan accordingly based on those feeder cities' school years or when they have large events where they might be migrating out. Or even having some local partnerships with local businesses in those feeder cities to, if you know people are coming, driving them to your properties, to your property can be an effective way to use this information as an existing host too.
Yeah. And that's one of the cool things is in this post, and we'll link to it in the show notes, is you can actually go in and see for any market, what are the feeder cities? And that I think it's just, one, it's fun and it's able to either confirm or maybe counter some of your preconceived notions of where guests are coming from for any market around the country. And then, like you said, can once you've sort of reinforced that hunch or that maybe anecdotal data you've had from already operating in that market and getting a sense of where people are coming from and visiting your property from, that you can then and further your marketing or partnership efforts in those feeder markets.
Very well said. Well, that's the best markets for the next 5 years, according to this methodology. Anything else before we sign off?
Now, be on the lookout when this comes out. We'll be in the midst of releasing our Outlook report mid-year for the US of essentially what we've seen over the past 6 months and how that's changed our outlook into the future. We're going to be doing some webinars coming up as well that will also be recorded. So if you want to get a better sense of what our thinking is on the overall economy and how that's going to impact for the next couple of years in short-term rental performance, take a look and read that report.
Excellent. Great stuff, Jamie, and great work on this report.
Yeah, thanks to the team for helping dig in. This one was a lot of fun.
All right.
Thanks,
Thank you,
everyone.
Jamie. Until next time.